we are going to try a little bit of Accounting 101. So this is just a kind of high-level overview of basic accounting. This comes in handy for various reasons. Whenever we end up doing financial consulting for clients, or sometimes even just for ourselves internally, I think having a little bit of basic knowledge about accounting is helpful. So Megan Stockwell and I are here kind of going through this process, so give us a try. Okay, so a brief introduction, just about accounting in general. So the accounting equation is very basic. It's assets equals liabilities plus equity. And this is basically what shows up on the balance sheet. And this is a really important concept to understand. And basically the balance sheet, it always needs to be in balance, where the total of the liabilities and equity must equal the assets. That's a given. The trial balance is something that is prepared after all the journal entries are made, and the trial balance basically has the ending balance of all the accounts that were impacted by the journal entries during the month. The trial balance needs to be in balance because the debits and the credits have to be equal to each other. So in any journal entry, the debits must equal the credits. And then in the profit and loss statement, all of the things in the trial balance that prepare the profit and loss statement go onto the P&L, and then all of the balance sheet accounts from the trial balance go onto the balance sheet. So that's how those reports are generated. The trick, I think, for the profit and loss statement is maybe not trick, but it's sort of simple. The concept is the profit is equal to the revenue less the expenses. So that part is pretty straightforward for people. Not quite as complex as the balance sheet. All right. The financial statements in general display the income and expenditures for the company and a summary of the assets of liabilities, shareholder equity. Okay, so the income statement or the P&L shows the income and the expenses. The balance sheet shows the assets, liabilities, and equity. The assets and the expenses have normal balances. In other words, these are the balances that are expected, and if they show up differently, it's a sign that something might have gone wrong in the accounting. So we'll talk about the normal balances a little bit later. And then we talked about some situations. So you asked me the question one day, so is a debit really an increase or is a debit a decrease? I said it depends. So it depends upon the account. So basically, for certain types of assets, certain types of expenses, debiting will increase them. And then for certain types of balance sheet accounts, for example, certain types of transactions, credit will decrease them or increase them, sorry. So it's a little bit confusing, but a debit and a credit could have different impacts on different accounts. Okay, so the liabilities, revenues, and capital all have normal credit balances. Sorry, go back one step. Okay, so the assets and the expenses have normal debit balances. So debiting the assets and the expenses has the impact of increasing them. The liabilities, revenue, and capital all have normal credit balances. So crediting these accounts increases them. If you understand these last two bullet points on this screen, everything becomes easy. So that's how I know when you ask me the question, right? So does a debit increase? I go, yeah, it depends. Mm-hmm. The debit to an account that normally has a credit balance would be a decrease. Okay, so assets, expenses all have debit balances, normal balances, and then liabilities, revenue, and equity all have normal balances that are credits. Okay, now here is where things become kind of interesting. Okay, so this is the rules for debit and credit. So if you're talking about a revenue account, typically it's a credit. So when you book an invoice, for example, it's going to be an increase to revenue. It'll be a credit to the revenue account. Cost of sales is typically a debit, but cost of sales is an expense, right? So cost of sales is typically a debit, and a positive balance would be a debit, right? And then an expense is also typically a debit, a positive balance. So a debit would actually increase the balance of a debit. So far, so good.
Yes.
On the right-hand side, okay, assets, liabilities, and equity. So these are balance sheet accounts. An asset typically is a debit. So whenever you debit an asset account, it'll increase it. Cash, for example, accounts receivable are both types of assets.
Okay.
Accounts payable is a liability. Whenever you credit the liability, it increases. So basically, when you book an invoice from a vendor, for example, it will typically be a credit to accounts payable, which increases the balance. So you owe more money. And then equity is a little bit hard to figure sometimes, but equity refers to the shareholder equity in the corporation. And as we talked about before, the assets plus the liabilities equals the equity. So you know how we do this quick ratio of looking at the assets and liabilities? This is what you're basically looking for. So you're looking for situations where the assets exceed the liabilities. That means things are good. If the liabilities exceed the assets, then maybe things aren't so good. Okay, so far so good. Okay, for the next time, what we'll do is we'll go through a series of journal entries that are kind of typical examples of journal entries that we come across every day in QuickBooks, but more importantly, the consultants also come across these journal entries in the course of doing work for clients. So let's save this for next time, and then we'll pick it up from here.